Hi, I'm Konnor.
And I'm Jasmeen.
Today we'll be taking you all on a trip around the world while going over the impact of foreign exchange rates on your investments.
When we talk about foreign exchange rates, we're building on the fact that many different countries and regions around the world have their own form of money or currency. Just as each country is unique with its own landscapes, food, and sometimes languages, each economy is different as well, with different industries, businesses, and workers who earn different wages.
Because each economy is different, the value or buying power of its currency will fluctuate relative to all other forms of money around the world. This fluctuation is called currency risk. As a Canadian investor, you don't need to worry as much about it if you're only buying Canadian stocks or bonds, or funds that invest in them. However, this risk is something to consider if you're looking to broaden your horizons and expand your portfolio's geographical reach.
Investing across various regions is common among investors, as it allows access to a greater number of investment opportunities, which can improve your portfolio diversification. If you're interested in investing in large American companies that make popular products like phones, social media platforms, or electric vehicles, you will need to be aware of currency risk, because these stocks are listed on U.S. stock exchanges and are purchased using U.S. dollars.
You might be wondering, what does currency risk look like practically? Think about traveling to a different country when you need to convert your money from the Canadian dollars you're using into the currency used in your destination.
Let's say we travel to the US, France, and Japan, and are planning to spend $100 on each item unique to these countries. We take our 100 Canadian dollars and convert 20 into US dollars to buy an I Love New York t-shirt, 30 into Japanese yen to buy an origami bird, and 50 into euros to buy a beret.
We return to Canada with our 3 items safely in our suitcase. However, by the time we open our suitcase again, we find that the value of our 3 items now add up to $95 if we were to go out and sell our souvenirs, even though there have been no changes to the contents of the suitcase. This has happened because the exchange rate between the Canadian dollar and the US dollar, Japanese yen, and euro have changed since we bought the items. In this example, the foreign currencies have gone down relative to the Canadian dollar.
When it comes to investing, we can think of a portfolio like our suitcase. When we use different currencies to buy stocks and bonds, we are also subject to how the value of these currencies change relative to the Canadian dollar while we own the stock or bond.
In our suitcase example, it's possible that when we return to Canada, the contents could have increased in value to $105 if the currencies have gone up in value relative to the Canadian dollar. When we make foreign purchases, we can't know whether the value of the currencies will go up or down, hence the risk. It's possible that a US stock's price will go up in value while the US dollar decreases in value, washing out the return altogether.
That is why exposure is important to consider when investing in foreign markets.
What do we mean by exposure exactly?
When you invest in foreign markets, your returns depend in part on the ever-changing foreign exchange market, which can be very volatile. As foreign exchange rates move up or down, so does your investment, creating exposure and thereby currency risk in your portfolio. Since foreign exchange rates can be unpredictable, investors tend to be more sensitive about introducing foreign currency exposures in lower risk portion of their portfolios, such as fixed income holdings.
So, to reduce this risk, you would need to consider hedging your foreign currency exposure to protect yourself. Currency hedging seeks to minimize the exposure of returns to changes in exchange rates between the currencies involved in the hedge. For example, Canadian investors can hedge against the US dollar by using some types of derivative securities to eliminate the impact of the Canadian and the US dollar exchange rate on their US stock investments.
Think of this as adding a new lock on your suitcase. Hedging will remove the volatility associated with currency risk and allow you to benefit directly from the performance of the underlying securities.
Some investment funds will hedge foreign currency exposures for you. If you're looking for mutual funds or ETFs that have this added feature of hedging, They will often be called currency neutral, hedged, or currency hedged.
You may not want to completely hedge your investments. Introducing currency risk to the high risk portion of your portfolio can actually act as a diversifier and dampen volatility in some cases. This occurs because some currencies, like the US dollar, tend to be a safe haven asset in times of market uncertainty. For example, the US dollar could appreciate in value when stock markets experience significant sell-offs, and could fall in value when the stock markets are rising rapidly.
Over the short term, currencies can sometimes lead to significant differences in investment returns. However, in the long term, currency fluctuations generally even out to some extent, but not always.
Investors have a lot to think about when investing in foreign markets. Foreign exchange rates introduce currency risk to investment portfolios and can have a big impact on returns.
Investors can hedge currency risks to minimize the impact of foreign exchange rates on their investments. Just like traveling to different countries can get tiring, so can thinking about foreign currencies, so we'll stop the trip right here.
Make sure to continue following our videos to learn more about investing. Have a great day.